Hey guys, what's up? Welcome to another episode with me, Shashank Godopa. And in today's episode, we are going to review the new Parag Parekh Large Cap Fund. Now, this is a very shocking statement by Parag Parekh because a lot of people in the market were surprised that they came out with a large cap fund because there are already so many large cap funds in the market. And everyone wanted to understand how do you diversify on this aspect. So today we're going to do a very quick review. We're going to go through their presentation and understand what is their philosophy behind it. Now, again, before all of you guys start commenting below on the thing saying kitna paisa mila and all of that, I am a SEBI registered research analyst, and this video that I'm doing, which is a review of Parag Parekh Large Cap Fund, I have not got even 1 rupee from this entire thing, right? So I've not been paid. I don't have any monetary incentivization, and I'm not applied to this NFO also. So my gain in this is absolutely zero because there are some amazing guys who, overanalyze everything in the market, right? I just do this because I like their investing style. I like Parag Parekh's investing style. My father-in-law has some shares in Parag Parekh Flexi Cap Fund, not shares, mutual fund units. I do not have anything, but I'm just giving a full disclosure for all of you guys. Now, as you know, the market is very, very bad, right? The market is not doing great at all right now. And that is seen in everything. And Parag Parekh has done something really good, which is they play on a lot of value companies. They play on companies that play on good quarterly earnings, good yearly earnings. They play on deep value. And some of these things which we also really like, we also pick up a lot of that, right? I know if you guys remember, but we also have a small case called Fluid C, which is very similar to this style of investing because we love his style. And even here, we have a lot of investments where we only focus on investing in large companies or mid-cap companies, but they have strong fundamental backed earnings. So this is something that I picked up from them. Obviously, I love learning from the best, and we are going to go a little more deep into it, right? Now, looking at Parag Parekh Large Cap Fund, the NFO opens on Jan 19th and NFO closes on Jan 30th. Yes, this is also available on Grow. You can go and take it if you want. Again, not paid from all of this to do this. So I know people will just assume everything. Just let's go and review this, okay? So the NFO is there. It is starting now. So what is the thesis behind this? It is a low cost, efficient access to India's top companies, broad cost efficient exposure to India's top companies by full market capitalization. So basically, what I'm assuming is the expense ratio should be low, and they are trying to play Nifty 100, which is going to be the benchmark. And Nifty 100 companies, they are going to play a game where they want to beat the Nifty 100 index, okay? Where broad diversification is there, lower cost. As I said, I think the churn will be low and expense ratio will be low, which is a good thing for all of us. Low active share, that means most of it would be passive itself, and smart execution, right? So let's understand this. Nifty 100 based on stock free float, weight of any holding capped at 10. That means they will not have any holding in their entire portfolio more than 10%. And this is something they've also done in the FlexiCap fund. If you see, they have Power Grid, IEX, many companies that are maxed out at 10%, right? Now, who decides to buy? Team chooses optimal implementation for smarter execution. So basically what they're doing here is they're doing a mix of things, right? They're not just going to buy companies. They're also going to use a little bit of futures and options to get more alpha or more returns on their entire investment. Now, if you look at Nifty 100 and why not Nifty 50 and Sensex, they've given a very good understanding that if you look at the market cap coverage, Nifty 100 has a better market cap coverage and a higher profit pool as compared to Nifty 50, which is very interesting. Okay, so the profit pool coverage is 76% in just Nifty 100, and this is the profit pool of everything, right? Based out of the top 500 companies. So out of Nifty 500, Nifty 500 contributes to only 24% of the profit pool, whereas Nifty 100, which is the top 100, contributes to 76%. So they're playing good because there your fundamental triggers will be better and your profit pool is coming from there. Now, understanding how they would execute, they would also, as I said, they would be doing a lot of futures and options. So they're going to do single stock futures. So when they feel that a stock is undervalued today, maybe fell down quite a bit, but the fundamentals are very strong, they are open to buying the futures of that stock in heavy quantity. And this is something we saw them doing in Parag Parekh FlexiCap, where they had bought December futures of Nifty, but that was more as a hedge on their portfolio, right? Whenever it kept going down, they kept adding more and more call options. Second, they're also going to buy index futures. If the index futures trades below index levels, the fund may use them to obtain exposure efficiently to reduce implementation cost. So here, two things can happen. One is hedging mechanism, and second is also going to take a small arbitrage, and that is, I think, their third part. Third is merger arbitrage. Now, this is something that very few people understand in India. It is also known as special situation games, right? Now, what happens is when there is a merger or a demerger, there is a lot of times that the acquiring company might be at a discount or the company that is going to be acquired can be at a discount. And when you do the share swap ratio, you will see that, oh, now I can actually buy this. The intrinsic value of a company has gone down. And it is very complicated to do it. And because it is complicated, there is an arbitrage to be played there. And that is what they're talking about. And right now, there's a lot of mergers happening, demergers happening, a lot of acquisitions happening. So here it can be very interesting to see how they play. But this is only in Nifty 100. So it's going to be interesting to see how they play in Nifty 100. Okay. Now, coming to the next part, smarter rebalancing and opposite active share. Okay. So the fund may rebalance gradually rather than on an exact date. So this is going to be on need to need basis. And because they're choosing the top 100 companies, pretty much the profit pools are good unless and until there is a big shock to the fundamental of a particular company, right? So this is very interesting. Opportunistic active share around corporate actions like demergers, special situations. The fund may phase entries and exits to reduce impact cost. So again, this is very similar to that merger arbitrage. This is a special situation arbitrage that they will be playing, right? Now, why stock futures? Use stock futures for better execution price. Use futures to buy the stock when at a discount to the cash market. Okay, very interesting. So if the cash stock is sitting at 285 and the future is sitting at 284, then there is a very easy 0.56% arbitrage, because according, for people who don't know this, futures and cash at the end of the month, let's say at the end of November, if this is November futures and cash at the end of the month has to come at the same level, right? So if I buy the future at 284 and this is the cash at 285, at the end this 284 has to become 285.9 if assuming the stock price remains the same. So the premium is lower here, and if this will catch up, so there is a 0.56% gain to be played here, 0.40. Now this is very rare, and you have to also enter very fast, and you have to enter in huge quantity so that it actually becomes valuable. If me and you do it 0.4% in the whole month, nothing is going to happen to us, right? But people with huge money can play this very well. This is very smart, very, very smart. And usually these are all programmed and automated right now. There are a lot of ARB funds that do this automated part. So that is how they would do it, right? Using index futures when attractive. So Nifty futures and Nifty index, again, you see futures discount. So whenever you see a futures discount like this, if you go and buy the Nifty futures to the index, you will make a good amount of money, because this is confirmed. You will get 0.6 arbitrage that is there, or 0.9% arbitrage. Confirmed you will get that, right? Maybe after expenses and all of that, 0.8 or 0.75 you will get. But it's literally a free arbitrage that you get in the market. Why does this happen? Because every market by theory and by law is inefficient. So whenever the market becomes inefficient or it gets mispriced, there are people who take opportunities of this and make a good amount of money. Merger related opportunities, they're giving a case study of HDFC and HDFC Bank. Shareholders of HDFC get shares of HDFC Bank. 25 shares of HDFC get 42 shares of HDFC Bank. On 13th April 2022, HDFC was at a 3.3% discount to HDFC Bank. So 25 shares of HDFC Bank was 59,000, but 42 shares of HDFC Bank was 61,000. So you basically have a 3,000 rupee arbitrage. Now you might say that, Shashank, who will play for 3,000? But they play in huge quantity in crores. So buy HDFC, instead of buying HDFC Bank, you would have got shares of HDFC Bank by doing this 42 rupees swap. And you would have made 3,000 rupees when you got that swap, because the shares of HDFC Bank were at 61,000. And this keeps changing. So HDFC Bank will go down, HDFC will go out, you buy more shares of HDFC. Then this happens, you buy more shares of HDFC Bank. Eventually, when that entire merger happens, you will get a huge arbitrage to play and profit, right? So smarter rebalancing of the fund. So index rebalances are announced in advance. Very good. But index funds attract only rebalancing date, which can result in significant inflows and outflows. Okay. Smarter rebalancing of the fund. So this is what they're showing, right? September 30th. Now, using low active share opportunistically. Okay, so better execution of demerger and special situations. I think this they already spoke about, right? Let's not do that. So there's given a case study of ITC and ITC demerger, how they use low active share opportunistically here. Okay, very interesting. Total expense ratio. Now, this is very important. So for all the people who are buying it directly, the expense ratio is honestly very low, right? 0.15 is very, very low, very close to some index funds. But it's very low for an actively managed fund. That means the chances of profit is very higher. I would not say chances of profit. Let's not go there. We don't know what profit will come. The chances of low expense is good. So that means your alpha can be good over a long period of time. Regular plan is 0.55. Regular plan is if you buy from a mutual fund distributor or you buy from any distributing platform, you will pay 4 times, almost 3 times more, which is very expensive. So I would suggest go for the direct plan, which is 0.15 only, right? And who should buy this fund, or who is this fund ideal for? people are looking for long term, 5+ years. And I know most of you guys don't hold mutual funds for 5 years. You hold it for 1 or 2 years only, and then you will switch to some new mutual fund that comes in the market. Do not do that. Stick for it for a long period of time. Any mutual fund that you have should be there for 5+ years, or else you will not make money. Someone who is seeking to significantly outperform the index, this is not a very high risk strategy. It is a medium to low risk strategy. So you will not get significant outperformance. For that, you have to play momentum indexes, or you have to play momentum games. Want concentrated bets on specific stocks, prefer active stock selection. So this is not for you. If you want to play high risk, high reward, that is there separately. And there is no exit load and there is no entry load. So you can buy and sell whenever you want, which is honestly good. And the minimum application amount is 1,000, not 500. And the minimum redemption amount is also 1,000, right? So again, very interesting, very interesting. And, if I have to actually take a call on what I believe it is good or bad, I believe it is actually good. Why do I believe it's good? Mainly because they're going to do a couple of things here, right? One is, see, definitely that low expense ratio is a good advantage for me. That is number one. Second thing is, they're not just buying stocks, they're also playing futures arbitrage. So when you play futures and options arbitrage, if you play it right, you can get at least 4 to 5% by doing nothing. So they're actually playing an arbitrage fund into this also, while holding cash positions of the same company. So that basically gives them a double advantage. Obviously, on a portfolio level, it might not be crazy, but this definitely gives them a advantage, right? So I would say, if I had to rate this, I would say it is a positive. But again, this is only for people who are looking to hold this company for a very long, hold the shares or units of this mutual fund for a long period of time. If you hold it for a short period of time, I think no mutual fund will ever give you anything, right? So if you're playing mutual fund game, it's better you hold it, because right now the market is not giving you any reason to hold. And Parag Parekh is known to control drawdown very well, which is known to not ensure your money goes down. So I think that is something that they're doing perfectly, right? So again, take your own call, do your own research, and I hope you enjoyed this, and I hope this was insightful for you. Thank you. Take care, and click on that subscribe button, because we are a channel that is growing, and my dream is to get the founder of Parag Parekh. If I can get Rajiv Thakkar on this podcast, it would be great. But yes, just a good fanboy of Parag Parekh and the way they manage their fund. They're one of very few guys who don't listen to the noise and do what they want to do, right? So that is something I really appreciate and like. Okay, thank you guys. Take care. See you. Bye bye.